The gap between gold and the gold stocks is the widest it's ever been, number one. Number two, the valuations, I'm a value investor, so I do look at valuations. Gold stocks rarely can be, you can rarely say gold stocks in the same sentence as value. The gap between gold and the gold stocks is the widest it's ever been, number one. Number two, the valuations, I'm a value investor, so I do look at valuations.
During economic uncertainty and high inflation, gold stocks serve as both a hedge and a key portfolio diversifier. With uncertain inflation and interest rate trends, gold prices could experience a prolonged period of outperformance. The metal continues to follow a bullish trajectory, and gold stocks are positioned for a potential breakout. Gold ended the week at $2,900 after reaching an intraday high of $2,968. Although overbought conditions can pose short-term risks, they remain a long-term bullish signal. Meanwhile, gold stocks, ranging from senior and large-cap miners to mid-tier producers and junior explorers, have rallied to critical multi-year resistance levels. AdrianDay of AdrianDay Asset Management highlights the significant undervaluation of gold stocks despite gold prices' resilience. He notes that the gap between bullion prices and mining equities is at one of its widest points in history, presenting a compelling investment opportunity. The sector's strong fundamentals are evident in corporate earnings. Barrick Gold saw a 70% year-over-year surge in earnings, with revenue climbing 19%, marking an acceleration from Q3. The company's Q4 earnings report cited increased production across all regions, driving higher gold output. Meanwhile, Royal Gold posted earnings per share of $1.63 on revenue of $202.6 million, surpassing analyst expectations of $1.52 in EPS and $186.2 million in revenue, representing annual gains of 60% and 22% respectively. The day also underscores the lack of investor participation in gold stocks, particularly in North America, where the average portfolio allocation to both physical and equities remains below 0.5%, compared to a 50-year average closer to 2%. He contrasts the total market capitalization of the global gold sector, approximately $600 billion, with the staggering $15 trillion valuation of just 5 major U.S. tech stocks. Even a small capital shift into gold stocks could have a significant impact, given their relative undervaluation and the sector's robust cash flow growth. Join us as we dive into the video for a deeper look. Don't forget to subscribe and click the bell icon to stay informed about our latest updates.
The gap between gold and the gold stocks is the widest it's ever been, number one. Number two, the valuations, I'm a value investor, so I do look at valuations. Gold stocks rarely can be, you can rarely say gold stocks in the same sentence as value. But I mean, you look at the gold stocks now, and the XAU, the individual stocks, Barrick, Agnico, they're selling at close to their lowest price to cash flow multiples, price to free cash multiples in their entire history. Barrick is within 10% of its all-time low valuation. We're not talking price, we're talking valuation. Agnico is certainly in its lowest decile in its entire history. Now, these are abnormalities, because normally when the price of gold goes up, multiples start to expand. And so to have number one, gold at record highs at the same time that the gold stocks are trading at very, very low multiples relative to their historic multiples. And number three, to have that at the same time as margins are expanding. Let's not forget that. And I've said this before, every quarterly conference call I get on with every company, they talk a lot about costs and how their costs have gone up and what their cost containment measures are and everything else. I wish someone on one of these calls would just say, yeah, our costs are up 3%, but look at what gold's done in the same time. The margins are expanding dramatically. So the gold sector is the only sector, well, not the only sector, sorry. It's the sector with the greatest growth in cash flow. Every quarter this year, the cash flow has increased. So yeah, and I think that's going to continue. The oil price does not appear as though it's going to run away from us. And I mention oil because, of course, it's the largest cost input into running a mine. And so, you get a 2, 3, 4% cost increase across the board. That's, I won't say meaningless, but it's minor compared to the increase in the cost in the price of gold. And so to have that combination of record high gold prices, very low, historic low valuations, and expanding multiples, at the same time, but North American investors generally are not in the sector, is just an astonishing opportunity. And if I may, Andy, I mean, just to give a sort of illustration of the potential leverage, you look now, according to various studies, the average North American has less than 0.5% of their portfolios exposed to gold, and that's physical as well as stocks. The 50-year average is closer to 2% for North Americans. So even if you go halfway towards the historic average, that's still a doubling of the interest. That's still a doubling of the exposure. You look at the entire gold sector in the world, it's about 600 gold stocks, about $600 million right now. You look at the market cap of just 5 tech stocks in the US, it's over $15 trillion.
Right.
Tiny amount, a small amount of the money that's in the tech stocks to roll over. And obviously, as we've talked before, some of them will go into foreign markets, some will go to emerging markets, some will go into real estate, some will go into value stocks or small cap growth or defensive stocks. But some of it surely will come to this sector that is exhibiting such dramatic cash flow growth. So you only need a very small amount of that money to flow into gold stocks to be meaningful.
Central bank gold accumulation has remained dominant in the global bullion market in recent quarters. In Asia, the People's Bank of China increased its holdings for the third consecutive month in January, while other official buyers, including Poland and India, also expanded their reserves, according to the World Gold Council. In 2024, central banks added 1,044.6 metric tons of gold to their vaults, marking the third consecutive year that purchases in this sector exceeded 1,000 metric tons. The fourth quarter alone saw a record addition of 332.9 metric tons. With total annual purchases surpassing 1,000 metric tons for the third straight year, equivalent to 29% of new mine supply, based on estimates from Metals Focus and the World Gold Council, Morgan Stanley emphasizes that the pace of central bank gold buying remains a key factor in shaping the market outlook. Day questions whether such actions would prompt countries like Brazil, South Africa, and Indonesia to reconsider their de-dollarization efforts or, instead, drive them to intensify their push for financial independence. He asserts that as central banks look for alternatives to the dollar, gold remains the most compelling choice. While the pace of accumulation may slow, Day believes central banks will continue to expand their gold reserves. Now let's redirect our attention to a video.
I mean, I think we all know the main reasons that gold is up, and that's because of the central banks. And, when you look at 2024, when you look at the numbers, but for last year, it was the third highest year on record. So I've heard some commentators say, oh my gosh, the central banks are not buying as much as they used to. And certainly, in the fall, there was a bit of an easing, but they came back strong at the end of the year. China, as you know, came back in November and December. And, the central bank buying ended up very, very strong, just down, obviously, from the record 2023. So it seems to me the central banks are going to continue to buy gold. Maybe the pace will slow. But when you look at why they're buying to diversify their reserves away from dominance of the dollar. Remember, it wasn't that long ago that the average or the aggregate for central banks' foreign reserves was over 70% in US dollar. So I know if I had over 70% of my clients' assets in a single asset, the SEC would ask me why. And so just for prudence, they want to diversify. And of course, that stepped up with the weaponization of the dollar. And I ask you a question, I'll ask it rhetorically. Maybe I'll answer it. I don't know. If I answer it, it's not rhetorical. But when President Trump threatens the BRICS with 100% tariffs if they don't return to using the dollar, do you think that's going to make Brazil and South Africa and Indonesia, is that going to make them say, oh gosh, we're really sorry, what a mistake? Or is it going to cause them to step up their efforts to not necessarily to move away from the dollar, but to insulate themselves from the possibility, of their reserves being under attack? I'll answer the question. I would suspect it's the latter, When we talk about moving away from the dollar, there's not an awful lot that they want to buy other than gold. So I think the central banks are going to continue to buy gold. We've seen other buyers, Chinese buyers, step up. Wealthy individuals and families in the Middle East are buying. Obviously, wealthy individuals and hedge funds in the US are buying. But North America generally is still lagging dramatically.
Gold has soared this year, posting successive record highs in a 7-week winning streak that builds on last year's rally. The metal's sustained rise has been fueled by substantial central bank purchases, a series of Federal Reserve rate cuts, and more recently, growing investor anxiety over U.S. President Donald Trump's disruptive tariff policies. Goldman Sachs Group has raised its year-end gold price target to $3,100 per ounce, citing robust central bank demand and rising inflows into bullion-backed exchange-traded funds, reflecting Wall Street's growing bullishness. Despite gold's record highs, North American investors are still underexposed. Why do you think that is? Join the conversation. Share your thoughts in the comments, give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.